All right. Let's see here. Let me know that you can hear me in the chat here. I'm pretty sure we're good, but I don't want to risk the feedback loop to actually confirm it on my own end. So if I don't see anyone type anything, I'm going to just assume that the audio is good. If you all yell at me and say, help, we can't hear you, I'll fix it. Yeah, well, yeah, welcome back. This is the second live stream that we've done, or I'm sorry, that I've done here in the last couple weeks. I'm going to be doing these actually a bit more frequently now, so you can expect these hopefully every like 2 times a month. And a great way to stay on top of when they're going to be held is to either go to the website and join the mailing list, denvercryptogroup.com. You can also join our Discord. I'll put a link for that here in the slides at the end, or you can follow on Twitter just at Denver Crypto GRP instead of actually spelling out the groups. It's just at Denver Crypto Group, but GRP instead of fully spelling out the word. So yeah, those are the best ways to stay up to date. Obviously, Meetup as well. Yeah. Tonight, I want to talk a little bit about staking and borrowing, mostly related to DeFi on Ethereum. I don't really, well, we'll see where the questions go. There are other options, and I think in the near future, these other options are going to be something you should know about or at least be aware of. But for now, the main game is still on Ethereum, even with all the crazy gas fees. So this is a beginner's kind of introductory level to just staking and borrowing. We're not going to really get into yield farming or kind of some of the more complex stuff. Yeah, this should serve as kind of a foundational introduction to it. And I'll take some questions at the end. 8 o'clock is kind of my hard stop. So we've got about an hour here, try to get through the presentation and see how many of y'all's questions I can answer. So with that, I'm going to share my screen. Let's go full screen here. And where did my notes go? Here are my notes. Okay, looks like we're good on the looks like we're good on the audio there. Awesome. Let's pop myself up here, the top right. Okay, so this is staking and borrowing. This is part of the ongoing series that's geared towards newer entrants and people coming into the cryptosphere. Obviously, we're in a bull market, a lot of new faces. I built the Denver Crypto Group back in 2017 was when it was founded. Under very similar circumstances, we had a massive bull market. Everything was going up in price. New people were flocking in, and a lot of people weren't sure kind of the best ways or the easiest ways, or even just a way to get into it. And so, we built a big group. We've helped, thousands of people at this point get into the cryptocurrency game or world, and plan to continue to do so. I offer some one-on-one consulting. I see a few people here in the chat who have taken me up on that. Yeah, for a little more information, you can go to the denvercryptogroup.com website, and it's pretty A to Z. Really, anything related to cryptocurrency, I can help you with that. And so, yep, that's the shameless plug here, and we will move on to the next slide. Okay, so staking and borrowing. The key takeaways that I'd like everybody to understand at the end of this is, obviously what is staking and borrowing, some of the common ways to stake, places to borrow or stake. Actually, probably more just borrow. I'm not really, I'll cover places to stake, but really more emphasis on places to borrow. And then just some very basic starter strategies if you actually do want to stake and borrow a little bit. I'll tell you what I'm doing, the DCG portfolio is doing, and hopefully you can get started on it. And then there's a resource list. So if you want to kind of continue your journey, you got some links and other ways to do so. So yeah, the first, let me grab some water here. About to talk for an hour. I'll hydrate. All right, so staking, which is also kind of lending and borrowing. So what is staking? Well, staking is really just the act of freezing some of your cryptocurrency, right? So normally it's in your wallet. You're a good crypto naut, and so you have self-custody over your cryptocurrency. It's on a hardware wallet or some other wallet under your control, where you control the private keys. You're going to actually freeze it to where you cannot move it. It's frozen where it's at. But in return for freezing it, you're going to get some sort of reward. And staking is, in my opinion, and other people may not view it this way, but staking is kind of the umbrella term for a lot of different things. But just anytime you're going to lock up your cryptocurrency, where you're not selling it on the exchange for where you're actually exchanging it for a different asset completely and have no claim on it. Staking, you still have a claim on the cryptocurrency that you've frozen, but you are going to get something in return for basically freezing your access to that cryptocurrency. So it's kind of an umbrella term, at least in my opinion. And some of the other things that you might hear people talk about, obviously staking, but lending, delegating, minting, these are all kind of different ways where you freeze up your crypto. You kind of you retain a claim on that crypto, but you can no longer move it freely like you would if you had not staked it. For an example, staking on Ethereum just basically means that you're lending your Ethereum to the Ethereum blockchain network to help keep it secure, right? They're moving to proof of stake. You can stake some Ethereum on there. You're going to freeze your Ethereum for, at this point, an unknown amount of time. But in return, your Ethereum and the software program that you're running after you stake it is going to help secure the network, right? So your Ethereum's frozen. You get a return, like a 5 to 10% return on the Ethereum that you've staked. So that's what you're getting back. And the Ethereum network is incentivizing you to help keep their network secure by providing that return. So that's just one example. Another one might be using Compound, where you lend or stake your Ethereum, and some other person is automatically able to use that Ethereum that you've kind of lent to the liquidity pool on Compound, and your Ethereum is frozen. You can get it out and move it whenever you'd like to, but it's basically out of your wallet and into the smart contract. So yeah, that'd be another example there. Lending is really just one way to earn a reward for staking on your crypto. That's sort of what I just described there on Compound, where you're lending it out. Borrowing, though, is when you're going to when you're staking crypto collateral to receive a loan. So that's very specific. These first two kind of have to do with staking and freezing your assets. The borrowing is where it's kind of the second step after you've already frozen it, staked it, whatever. You're going to use it as collateral and then receive a loan based on that collateral. And generally, this is an over collateralized loan. So maybe you deposit like $100 worth of Ethereum, and you would be able to take out a loan worth maybe $35 of like a stable coin or some other different cryptocurrency, or even the same cryptocurrency that you provided as collateral. So that's basically what staking and borrowing is. Freezing it, getting something in return. When you're borrowing, you're just using what you've staked as collateral to then receive something else. So yeah, hopefully that makes sense. If you have any questions, pop them in the chat there, and I'll get to them at the end. So yep, some common staking methods are going to be, obviously what I talked about with Ethereum there, where you're supporting a proof of stake blockchain network. They need you to lock up your stake. so that you have some skin in the game, basically, and then they'll allow you to perform and help with the security of the blockchain network, and then they pay you a small reward for doing so. And that's exactly how staking on Ethereum works right now, and a few other blockchain protocols as well. I think Cardano and well, now I'm starting to name them. I'm sure I'm missing a few. People will tell me in the chat, but that's basically when you're staking a cryptocurrency token to support the network. Another common staking method is going to be lending, either to liquidity pools or to other users. So on Uniswap, if you've heard of the decentralized exchange called Uniswap, you can provide liquidity to a trading pair. So let's say it's Ethereum against well, Bitcoin, but it's technically wrapped Bitcoin. But Ethereum versus Bitcoin, people are trading that back and forth as the prices go up over the course of the day. But because it's a decentralized exchange, there's no central entity that's like pooling all the funds and managing all the wallets. It's just a smart contract. So users are incentivized to provide liquidity to everyone that's trading it, and they get a little bit of a reward on the basically the exchange fees for when people are trading and using the assets that you've provided liquidity for. And then obviously there's also lending to other users. That's the example when I talked about Compound. You provide some collateral, some Ethereum, and then somebody else wants to take a loan out in Ethereum. They're going to be able to take out some of that loaned. They're going to be able to pull out of that loaned Ethereum, or that lent Ethereum that you've provided to the smart contract. Third common staking method there is going to be minting of synthetic assets or stable coins, other kind of similar types of tokens. When you want to create a synthetic asset like synthetic Apple or synthetic Tesla, which is just a token that's pegged to the price of whatever one share of Apple stock or Tesla stock is. When you go, the act of minting that on the blockchain is going to require you to put up some collateral, freeze it in place, and then you will be issued a corresponding amount of that synthetic asset. So now your Ethereum can give you exposure to Tesla or the price of gold or oil futures or other commodities, things like that. But you've got to you lock up a little bit of Ethereum or some other cryptocurrency. Usually it's like the platform's cryptocurrency. So like on Synthetics, you would lock up some of their stable coin and then mint synthetic Tesla or synthetic Apple. And then another way would be the DAI system. So there's the MakerDAO, and they are the creators and maintainers of the DAI stablecoin, which is just a stablecoin is just a cryptocurrency that's pegged to the price of the US dollar. So one DAI is almost always nearly worth $1 US, and they have some automated code that kind of balances that price out and keeps it that way. But the way that new DAI is created is you provide collateral, you stake it or lock it up. You can think of it kind of either way, but you lock up some sort of collateral and then you mint the DAI stable coin, and there's a loan process or an interest rate and a few other nuances to it, but that's that would all be an example of minting a stable coin. And then the last one there I have is delegating your right to vote on governance issues. So a lot of these different protocols like Sushi and Uniswap and Luna and different, most of these decentralized finance protocols have some form of tokenized governance where any sort of the major change that's made to the code base or the roadmap or the direction of the project needs to be approved by the users or the holders of the token. So if you own a little bit of the governance token, you're able to vote on different issues that come up and directly affect the path forward for whatever project's governance token that you own. A lot of them require you to stake the governance token, just to sort of prove, you can't just buy a ton of it off of the exchange and then vote, one way or the other on some sort of controversial issue, and then, turn around and sell it all for Bitcoin and, get out of it. There would be a lot of manipulation. So they actually ask you to stake your governance token. And then, whoever's staked the longest, or there's some sort of minimum staking period, then those are the people who've kind of locked in their governance tokens and prove that they have a long-term interest in the health of this project. That is who's allowed to vote on the governance issues. So, yep, those would be the most common staking methods, at least as I see it. Okay, so places to borrow. So that was kind of staking. If you want to, go and take the second step and actually borrow against some of your collateral, there's basically four of the most popular places are going to be BlockFi, Nexo, Compound, and Aave. BlockFi and Nexo are centralized. I think BlockFi just raised like a Series D, like some millions of dollars. So the custody of your funds is controlled by a centralized entity, not a smart contract, like is the case with Compound and Aave. And so there's obviously some trade-offs to this. BlockFi could get shut down by the government. Nexo could get, ordered to cease and desist all of their business operations. And at that point, any cryptocurrency or any loan that you have with them, all of that's probably going to be frozen and potentially could be seized or forfeited, but it's going to be unaccessible. So that's the main risk when using some sort of centralized entity to borrow against. Sometimes you can get better rates there, but the one thing that I actually learned recently is that BlockFi, and I believe Nexo as well, do not allow you to earn interest on the collateral that you've provided. So if you deposit, 100 grand of Ethereum and then take out a loan on BlockFi, and I think you can only get a loan in US dollar, you are not going to be able to earn any interest on that Ethereum that you've deposited. Now with Compound, you actually would earn a small interest rate for your collateral. And then, it would obviously be offset by the higher interest rate of your loan that you borrowed against, but it would reduce that amount that you're having to pay back on the loan. So that's a pretty big advantage, in my opinion, for Compound and Aave and the decentralized options here. And also, it's important to note that I believe, so Nexo will allow you to take out, borrow or take a loan out in different cryptocurrencies and US dollar and stable coins. BlockFi, I believe, is only going to allow you to take out US dollar. Compound and Aave, they have a big list of cryptocurrencies that you can borrow. And so they're kind of a better solution than BlockFi or Nexo, because you can provide any kind of collateral that they accept, a bunch of different options, and then you can borrow a bunch of different cryptocurrencies or a US dollar stable coin on the decentralized options. So the decentralized ones I like a little bit better. Those are the ones that I use and generally recommend to people. But there are some advantages to the centralized solutions. You've actually got like a support line you can call, you can talk to customer service, but your funds are not going to be under your control. Whereas with the decentralized solutions, the smart contract is just an automated process. As you pay your loan back, you get your crypto back, and there's really no middleman. And the smart contracts have been pretty battle tested at this point, so they're very reliable and highly unlikely that they contain any sort of vulnerability. So yep. Those are the places to borrow. And then lastly here are just some basic kind of strategies. So the very first place to start, and this is where I started, is just to stake what I already own. I've chosen to do like vetted decentralized methods, primarily Compound, but there are some centralized options. And I do know that Kraken and I think Coinbase offer like staking for Cosmos, and a few different other cryptocurrencies. So if you have, you have a chunk of Cosmos that's sitting on Kraken, you can actually stake it for a fairly decent return on there. And I believe there's not a lockup period. So, you can earn, I think it's like 12% or 15%, staking it just through the exchange, which is pretty easy. And then when you want to get it back, you might have to wait a day or two, but I think you might be able to get it back immediately. So there are some centralized options. Obviously, the ones that I just told you about, Nexo and BlockFi, you can also stake on those platforms. I think I was talking about them in the context of borrowing, but you can actually also stake on them, and they offer some pretty good returns. Up 8%, 9%, 10% on whatever crypto you keep with them. So yeah, staking what you already own, that's a great place to start. The second option there, and this is a strategy that I've used and definitely intend to use kind of when this bull market ends and we enter into a downturn and a bear market, but it's actually to borrow stable coins to allow you to hedge against bear markets. And this one's not, I'm calling these basic strategies. This one's a little bit more complicated. Let me see if I can share my little example here in my text document. Let's see here. So I think you'll be able to see this. But basically, if you were going to hedge against the market going down on you with Ethereum, here's just a little example that I've drawn up. But we're just going to assume that you're going to start out with an initial investment of 10 Ethereum, and Ethereum is worth $1,000. So you've got $10,000, 10,000 US dollars worth of Ethereum. That's 10 Ethereum at the current price. You go over to Compound, you deposit that as collateral, and since it's an over collateralized loan, the smart play is to really only take out about 35% of what you put in. So you put in 10 grand worth, only take out $3,500 worth. That's about 35%. That way, if the market really tanks in price, you're not going to face any sort of liquidation, because that is a major risk. And so, okay, so right now you've got 10 grand in Ethereum. It's locked into Compound, and because it's locked into Compound, you have a $3,500 USDC loan. This is just a stable coin, so basically you have $3,500 worth of cash. Okay, you don't do anything with it. It just sits in your wallet, and 6 months later, the price of Ethereum goes to $650, right? We were at 1,000. Now we've come down to $650. So currently that 10 Ethereum is now worth $6,500, right? You've lost $3,500 because the price has gone down. What you can do though, because you have this $3,500 loan in stablecoin, and that has not, it's stayed at $3,500, it's just US dollars. You can now buy I think it's like 3.8 Ethereum, but I just rounded up to 5.4 Ethereum for that $3,500. So now 6 months later, you have 15.4 Ethereum, and it's still worth $10,000 at $650 per Ethereum. Your loan is gone. You've turned this loan, this $3,500 into Ethereum, but now you've got 15.4 Ethereum. So 6 months goes by, the market bottoms out, everything comes back up to our original price, right? So 6 months later, Ethereum is now at $1,000. So currently, you have a claim on 10 Ethereum that's locked into Compound, and then you have 5.4 Ethereum that's just floating around in your wallet. But across all of your investments, you've got basically 15.4 Ethereum that's worth $15,400. So now how do you get access to all, you've got to pay your loan back, right? You want to get access to your 10 Ethereum back in case, you want to sell it or you need a new car or something. So you've got to sell some of this Ethereum. So if you sell 3.85 of the Ethereum out of this 15.4, and this, you're not selling, the reason you're not selling 3.5, you're selling a little bit more is I'm just assuming that there's a 10% annual interest rate on the loan you took out. So it's $3,500. They're charging you, Compound is charging you 10% annually on that loan. So you got to sell basically $3,850 worth of Ethereum, turn that into USDC, and then pay back your loan. So now you've paid back this $3,500 loan plus the interest. So all of your collateral is now unlocked. So your 10 Ethereum, it's unlocked, it's back in your wallet, and you have another 1.55 Ethereum left over from when you bought this 5.4 and after you sold this 3.85. And so that works out to basically a 15.5% annual return. And you've got 11.55 Ethereum free and clear with no, it's just in your wallet, you own it. And then that's instead of the 10 Ethereum that you'd have if you'd done nothing. So all you had to do was provide some collateral, take out an over collateralized loan all through a smart contract. It's like 5 clicks. It's pretty easy. And then you just wait for the price to go down. If the price, happens to go up, you've got this $3,500. You got to pay back a little bit of the interest. So you got to pay basically $350 each year for the opportunity to buy back in at a lower price if the market tanks. So that's a basic way. Well, I say basic, but I feel like that was kind of a complex explanation. But that's the way that I've used this borrowing and lending platform of Compound to basically hedge against bear markets, right? If the price keeps going up, I don't really care. I'll pay $350 every single year. I can easily afford that if the cryptocurrency keeps appreciating. But in the case where it just goes down over the course of 1 or 2 years, now I've got an option to buy back a little bit more and actually end up and accumulate more cryptocurrency while the market goes down. So that's a great, just kind of a smart way to manage your portfolio. And then the second one here is basically providing collateral with a specific cryptocurrency and then borrowing more of that cryptocurrency for like a leveraged long position. So you could go over to Compound, deposit some Ethereum, and then you would borrow, instead of borrowing a stable coin, like in the example I just showed, you would actually borrow more Ethereum. So you provide your Ethereum as collateral to take out a loan of more Ethereum. So now you've got way more Ethereum than what you originally had. And then if the price appreciates, you're able to pay that back and end up, pocket the difference basically as the price goes up. So you can use this to long the market, or you can use it to short the market, or really just protect yourself, I guess. Protect yourself from a bear market or profit more in a bull market. So yeah, those are kind of the 3 basic strategies. And these are ones that I've used myself. I had this slide in the last presentation. I'm probably going to put it in every presentation, but cybersecurity is such a huge deal when it comes to cryptocurrency. And really, you can take all this advice and become an expert in DeFi and portfolio management and altcoin investing and whatnot, but it really doesn't mean anything if your crypto gets hacked or stolen or you lose access to it. So, the 5 things I recommend here: have a dedicated email for anything crypto related. Tuta Nota or Proton Mail are pretty good. You can make a free account on those. Those are encrypted emails. Password manager to save all of your different passwords for the different exchanges, and different wallets and different. You generate a lot of passwords in crypto. For wallets, exchanges, different things. It's nice to have a password manager that will create a very long, secure password with a number, a letter, a capital, a lowercase, a symbol, and that's unique. Every single password should be unique. Third is a hardware wallet. There's the Ledger, there's the Trezor. I think there's a Keep Key. That's actually a local Denver company that produces those. And there's a few other ones that are like specific for a specific cryptocurrency, kind of like the Cold Card or something else. But so hardware wallets, very good. Make sure you're bookmarking your crypto websites. Don't go to coinbase.co, go to coinbase.com. Coinbase.co will look exactly like Coinbase. and if you log into it, they will use your login information and go try and log into the real Coinbase and steal all of your funds. So make sure you're bookmarking the correct crypto websites and not just like hoping you type them in correctly. And then lastly, SIM lock your phone. Make sure you're using 2FA that is not just you receiving a text message. So Google Authenticator, YubiKey, there's some open source alternatives, I think like Aegis, AEGIS, if you don't trust Google. But yeah, call up your cell provider, SIM lock your phone, and make sure you're using 2FA that is not a text message to your phone. It's some sort of authenticator app. So, all right, that's my cybersecurity spiel. Make sure you're doing those things, or it's really, you might be wasting all of your time trying to learn all this new stuff and then just have your crypto hacked and stolen. Resource list, this is down in the description of this video, so you don't have to worry about trying to like type these in off the slides. The link should be down there. But basically this DeFi roadmap it's a little overwhelming, but it kind of follows the flow of like somebody drinking the DeFi Kool-Aid and getting into DeFi. It's pretty interesting. It's a visual like graphics, which I like. I'm a fairly visual person. So yeah, check that out and figure out what part of the roadmap you're on. Is kind of interesting. And second here, we've got the DeFi workshop, part 1 and 2. This is something that I presented actually on a different YouTube channel for the Open Economy Initiative. But if you're really wanting to get into DeFi, there's 2 different parts on that, and that'll walk you through stuff much more in depth than what we did here tonight. This is just kind of basic introductory stuff. And then if you want to know what the current interest rates for lending or borrowing your crypto are, defirate.com/lend or /borrow. And then this here is a great, I didn't really talk a whole lot about the risks of this decentralized lending, or just lending and borrowing in general. This is a great article on the risk when you're participating, especially in DeFi, and also that also includes the lending and borrowing aspect of it. So definitely check that out. I think there's the risk of a smart contract going bad. There's the risk of an exit scam. There's the risk of the centralized entity like BlockFi or Nexo going out of business or becoming regulated, or having to turn over all their user data to the government. So there's quite a few different ways that you can get screwed in the crypto world, and that's just because it's so new. But with that increased risk comes increased opportunity, and so most of you that are here are willing to make that trade-off, but you should know about the risks. I think that's it for the presentation part. This is my email address if you want to reach out to me. 9 to 5, Monday through Friday, I'm available to do some consultation. Oh yeah, and I just set up a Discord I just set up a Discord where I'm gonna probably be posting some I will be posting some like macro news, like significant cryptocurrency news. I'll probably be posting some like different cryptocurrency picks, upcoming projects. They're sort of excited, and also just like a chat to hang out in. And if you're a trader, I've been doing some trading lately. Happy to talk to you about that stuff and see what collaborate or something like that. And if you're into the day trading thing, or really just whatever, just come hang out, talk. I'm on there most during the day. Even if you have questions like related to getting started with cryptocurrency stuff, I'm happy to answer that on Discord. If it's if you're on there. So check out the Discord. But yeah, that's about it for tonight's presentation. I don't see any questions in the chat just yet. So maybe I did such a great job presenting that no one has any questions. I somehow doubt it, but if you do have some questions, pop them in the chat here and hopefully I can answer them. If we don't have any, I'll probably just end the stream now, but otherwise I'll hang out for a little bit if anybody's wondering about anything. All right. right, David, what is the minimum to stake Ethereum? What is the time period required to stake? Okay, so I'm assuming that you're talking about Ethereum 2.0. The minimum is going to be 32 Ethereum. However, there are some like pooling services where I don't know what the minimum amount is. Each one is kind of different. And I don't really have a recommended Ethereum staking pooling service. But yeah, the technical minimum is 32, but some people are combining their Ethereum with other people to reach that 32 amount and then kind of all staking it together. And I believe they're able to do that in a way that kind of limits the counterparty risk of like somebody walking off with all of the funds. I haven't dove too deeply into that yet. I'm actually not staking any of my Ethereum because the lockup period is sort of unknown, but yeah, 32 Ethereum would be the minimum. All right, anybody else? And I'm thinking to do, I got an email from a former, well, I'm still a member of the Denver crypto group who basically asked me, or just sort of informed me that some of the technical stuff, like the cybersecurity basics that I just listed, the technical stuff with that is kind of daunting for a lot of folks, especially those that didn't grow up with computers and technology. So I'm debating, and let me know in the chat what you guys think about this, but I'm debating just doing like a beginner's night. I used to do them back when we were doing it in person, where everybody just brings their laptop. We can help you get set up on the exchange, or get set up on LastPass, get set up on set up on your email, if you're kind of, or even just make a transfer from the exchange to your hardware wallet, set up a hardware wallet, just kind of all the basic foundational stuff, where you can ask questions and people can help you. It might not be as effective through Zoom, although that's where I'm doing most of my consultations. So I feel like it would be possible. But I don't know if there's an appetite for that. If everybody is stuck in kind of the basic introductory steps, then that would be worthwhile. Or I could also do one about NFTs. I'm not sure. I might do one on NFTs, because I've been getting asked about them a lot lately, and there's some good and there's some bad. I think it's probably apt to compare it to the ICO craze back in 2017 and 18, where there were some good projects that came out of it, and it was overall it was a good thing, those initial coin offerings. But 90% of them, or probably more like 98% of them, all kind of went away, and the bubble sort of popped. I feel like NFTs are kind of similar. Like the bubble will probably pop on them, but what remains is going to be just like part of the ongoing ecosystem that we'll be talking about 10 years from now. So maybe I'll do NFTs if there's not a huge appetite for the beginner stuff. But I don't know. That was kind of the founding principle of the group, was to just help newer people get onboarded into the space. So I want to make sure that that's something we're also offering. I just don't know how easily it is to do that without meeting in person. But yeah, so let's see here. All right, well, it doesn't look like we have too many other questions. Chip's good on the basic stuff, so that's good. I'll give it another minute or two. If nobody else asks anything, then I think I will call it. The name of the Discord is just the Denver Crypto Group on Discord, and it's got the same logo. It's this same little logo. You'll see it on there. I don't know if it's private or not. I mean, if you go to the website, if you go to denvercryptogroup.com, at the very bottom, scroll to the bottom of the website, there's a Discord icon, and you can just click on that, and that invite should just take you right to the Discord and join it. But yeah. All right. Cool. Glad to hear it, Anthony. I will watch for you in there. What DeFi do I like? What DeFi do I like? I mean, what is it? Yield or YFI, where you can just deposit, you can just deposit some collateral, and then they basically take it and like apply it in the most efficient way possible. Like they kind of do all the heavy lifting for you. I like that YFI, just because that allows me to save a little bit of time. I don't have to come up with my own, yield farming DeFi strategy. I can just sort of let them do it. I mean, I know the returns aren't as high, but it's like a nice medium in between making your own complicated DeFi strategy and just like only staking it. It's kind of a middle ground in there. So yeah, I like YFI. To answer your question there, Shane, Chip, that would be great to review security, please. Yeah, I mean, yeah, basically everything on that security slide, just be an evening where we help people go through that and get onboarded with it. I'd probably do it through Zoom, and I probably would not stream it, because I'd have people, if somebody gets stuck, I would want them to share their screen, so that we could see, what's going on. I don't know. I gotta think about that, because that's tough. That's like a pretty big security risk if we're doing that, like not in person. But I feel like there is a need for it, because there's multiple people that have talked to me about it, and it's hard to get started. There's a pretty steep learning curve with a lot of this stuff. So let me think of a good way to do that. Or if you all have any suggestions on how to help people set up like password managers and create new emails and other things like that. I mean, I could just do a demonstration. That might be the best way to do it. Just demonstrate setting all that stuff up from scratch, and then people can ask questions. And then if you really get stuck, maybe we could hop into like a private Zoom meeting, and you could share your screen briefly, so myself or somebody else that is trusted can help you. I think that would be a good way to do it. Okay. So yeah, so let's do a beginner's night, and we'll do a beginner's night and something about NFTs. I think those will be the two upcoming events here. So yeah, just check the Twitter, or the Discord, or the email list. Get yourself on the email list, and you will know when those events are. Thanks, Dan. Good to see you. Glad you made it out. David, I heard from another channel, once Coinbase goes public, you can stake Ethereum on their platform and earn 7%. I wouldn't be surprised if they did that. I think Binance International is already offering some staking stuff. I have not had that confirmed, David, but that I would not be shocked if that's the case. I wonder, the one question I have about that though is like, is there a lockup period, right? Because right now, if you stake your Ethereum, it's basically locked until Ethereum 2.0 is live, and then you can, unlock your funds. So it's just sort of indefinitely locked until they roll out ETH 2.0, which, is slated to be coming soon. But if there's any kind of delay, I mean, you could not have access to your Ethereum for a very long amount of time. However, as long as your staking software is still running and you're not getting your stake slashed, you'd be earning interest that entire time. So, if you don't need it, you don't need the liquid funds, then it would make sense. But if Coinbase is going to offer 7% return on Ethereum staking, they've got to be probably staking some portion of their Ethereum holdings, and that's locked up indefinitely. So if a bunch of people, start the staking and then they all try to withdraw it, that could put Coinbase in kind of a precarious position. where there's like a run on their Ethereum holdings because a lot of it is locked up, but they're providing people returns. So they'll probably do something like you can't withdraw your Ethereum in less than a month or something like that. But we'll have to see what they say. Oh, 3 months. Shane's saying 3-month lockup. Okay, that makes sense, because you could really they could get in a lot of trouble if they're just offering immediate withdrawals, but they've locked away a bunch of Ethereum. Okay, Cameron. So yep, I think that's gonna do it for tonight. I don't see any more questions there. 7:45. No lockup on Polkadot or Kusama. No lockup on Polkadot or Kusama on Kraken, and it is 12%. Yeah. So yeah, I think I said Cosmos on Kraken, but yeah, also Polkadot and Kusama. Kusama, I think, is just like the testnet token for Polkadot, but it holds some value. But yeah, you can stake all of that on Kraken, and there's no lockup period. So if you don't mind having your funds on a centralized exchange, or maybe you're trading or something, yeah, you can lock them up on there, which is pretty good, and that's a pretty nice return. But you do have to trust Kraken to like not go out of business. So yeah, I mean, the hardcore crypto people would say not your keys, not your coins. It's custodied by someone else. But I mean, Kraken is a pretty reputable exchange. They're doing some cool things with banking up in Wyoming. And maybe don't put your entire portfolio on there and stake it, but a portion of it, it might not be too bad. So yeah, there's definitely some different options. If if you guys want to still talk about the staking, or really just anything other crypto related, I'm going to plug I'll plug the Discord one last time, and I really ought to put the link for that in the chat, and then I think we're going to call it for the evening. So let's see here. Let me get the link. Where did it go? I can't copy that. Oh, I'm just gonna have to start up Discord, I guess. All right, let's see here. Hey, nice. We just got a few people joining up already. Cool. All right, invites. Let's make an invite link that never expires. What could go wrong? All right, there's the link for the Discord right there. Yeah, come say hi. I think that's going to do it for tonight. Thank you, everyone, for coming out. Bye-bye banking system. There we go. I love it, David. And yeah, thanks for coming out. Hopefully you all enjoyed it. If you have any feedback, feel free to reach out to me. I'm always trying to do this a little bit better. And yeah, we'll do some NFTs and like a beginner's night here coming up. So stay tuned and have a good one. Bye.